In today's episode of the Daily Brief, I'll talk about two big stories. I first talk about ITC and the breakup its shareholders had been waiting for so long. I then talk about a new kind of war between countries that doesn't involve guns and tanks. Welcome to the Daily Brief show by Zerodha, where our aim is to simplify the biggest news in the financial markets in a way that's one level deeper as compared to other news channels. I'm your host Kashish Kapoor. Today is Thursday, 19th of December. You can find us on Spotify, Apple Podcasts, or wherever you consume your podcast. The Daily Brief is also available in Hindi. And if you like reading instead of watching or listening, you can sign up for our No Spam newsletter for a quick rundown. All the links are in the show notes. So let's begin. If I got a rupee every time someone in the media or stock analyst talked about the possibility of ITC demerging its hotel business over the past decade, I'd probably be a crorepati by now. That's how anticipated and talked about this event has been in the recent corporate history. Probably second only to the much hyped HDFC and HDFC Bank merger, which also wrapped up recently, and something we talked about in the Daily Brief as well. So why am I bringing this up now? Because on 17th December, ITC finally got all the approvals for demerging its hotel business effective 1st January 2025. It's about 3 months later than ITC's initial estimate in August 2023, but hey, better late than never. Why is this such a big deal? To put it simply, ITC's hotel business was kind of a burden on the company, and every ITC shareholder was eager to see this demerger happen, partly because it would address a long-standing criticism of ITC's business model. We'll talk about that in a while, but before that, let's talk about ITC itself. Think of ITC as the ultimate example of a conglomerate, a single company with several businesses under one roof. For ITC, these include cigarettes, FMCG, hotels, agriculture, and paper packaging. Conglomerates come with their own set of pros and cons. On one hand, they can leverage their size and diversity to raise funds more easily. For instance, Reliance used its oil profits to fund its telecom and retail ventures. But on the other hand, the profits from strong businesses can get sucked into weaker ones, creating a drag. And in ITC's case, the weaker business was hotels. Here's why. Hotels got a lot of love, but gave back very little. ITC invested a massive 22% of its capital into hotel businesses, but it contributed just 3% of its operational profits. Compare this to ITC's cash cow, cigarettes, which only used 8% of capital, but generated a whopping 80% of operating profits. And this makes sense. Cigarettes don't require heavy reinvestment, and they have one thing hotels can't match: addiction. You see, even ITC's FMCG division has also been capital heavy with low returns so far. But it still didn't get all this hate that hotels was getting. Why? Because FMCG was different. It was showing signs of improvement. The returns on new investments, what we call capital efficiency, have been rising steadily. Hotels, on the other hand, have been around since before they were merged into ITC in 2004, and yet the returns weren't matching up. But why were ITC's hotels struggling? Running a hotel business comes down to two models. First is owned hotels model. ITC builds and owns the entire property, runs it, and hopes to turn a profit. This is expensive and risky. Delays and cost overruns are common, like ITC Grand Chola in Chennai, which ended up costing 1200 crores instead of the planned 800 crores, and ITC Narmada in Ahmedabad, which was delayed by a decade with costs rising to 100 crores. Second model is called managed hotels model. Here, ITC partners with hotel owners, managing their properties under its brand without owning the asset. This model requires much less capital and allows for faster expansion. For a long time, ITC stuck to the owned hotel model, which dragged down profitability. But in 2018, for the first time, they started shifting to an asset-right strategy, focusing more on managed hotels. This change is already paying off. From FY18 to FY23, revenue and operational profit for ITC hotels grew at 13% and 31% CAGR, compared to the near flat growth in the previous 5 years. Today, 55% of ITC's hotel inventory is under the managed model, and this is expected to hit 65% by 2030 as per their latest quarterly report. Their new brands, Mementos and Story, are expanding entirely through partnerships with hotel owners. So why now? The timing of this demerger is quite interesting. It could have happened earlier, but COVID delayed things. The pandemic hit the travel industry hard, making it impossible to spin off a struggling hotel business. But post COVID, the recovery has been strong and enthusiasm for hotels has returned. In fact, it's not just ITC. Three other hotel businesses, Leela, Ventive Hospitality, and Brigade Hotels, have filed for IPOs recently, aiming to raise about 8,000 crores. So the market looks ready for ITC Hotel to stand on its own. Now, what's next for ITC? The big question now is, will ITC stop here or will this demerger kick off a spree? Could we see their FMCG or infotech businesses spun off next? Here's why demergers can be powerful. When a business splits off, the investors start valuing each segment separately. If a weak business was dragging down a strong one, separating them can unlock value. We have seen this play out many times in financial history. Will ITC's FMCG or Infotech division follow this path? Who knows? But if history is any guide, there's definitely potential for more value to be unlocked. For now, let's see how ITC Hotels perform on its own. Will it finally thrive without being tethered to ITC's other businesses? Only time can tell. Now, in the next story, we're diving into an economic war you've probably never even heard of. Here's the headline for you. The US and China are locked in a battle that's already cost American companies $130 billion in market value. And guess what? This is just the beginning. Now, if you think global competition between superpowers means armies and tanks, think again. Today, wars don't come with gunfire or battleships. As one paper in the International Security Journal puts it, we're in a new era of wars without gunsmoke. The weapons here are semiconductors, economic sanctions, and supply chain disruptions. But fun fact, this isn't as new as it sounds. Way back in World War I, Britain tried to slow down Germany's rise by cutting off its access to shipping lanes. What did Germany do? It doubled down, making its factories more efficient and finding alternative suppliers. Sounds familiar, right? Because, spoiler alert, China's doing the same thing right now. And get this, it's not just the first time the US has played this game. In the 1980s, the US went hard on Japan, restricting satellite technology exports to stop Japan from overtaking America in tech. What did Japan do? It adapted and leveled up its technology. Deja vu, right? Yes, except now the stakes are much higher because China's economy is way bigger than Japan's ever was. Let me put it into perspective. Research from Jennifer Lind at Dartmouth College shows that China has already surpassed the Soviet Union's peak power during the Cold War. Yep, the country that kept America on edge for decades. China's already stronger than them. And here's the kicker. China's economy has overtaken the US in purchasing power terms. Sure, we like to call China a developing country, but cities like Beijing and Shanghai have a GDP per capita on par with South Korea. It's not just one China, it's multiple Chinas. Some regions are booming, others are still catching up. Now let's talk about America's game plan. Since the Bush administration, the US has been turning up the heat on China. But it was Trump who really cranked it up, adding 3 times more Chinese entities to restriction lists than all previous administrations combined. And Biden, he added even more. So what's the US toolkit? Here are 4 big weapons that they use for this. First is the entity list. Think of this as America's blacklist. If you're on it, US companies need special permission to sell you anything. Huawei is on this list with 149 entities. Second is the SDN list. This is the nuclear option. If you're on the specially designated nationals list, you're cut off from global financial system. Remember Carrie Lim, Hong Kong's former chief executive? She had to get paid in cash because no bank would touch her. Third is the military end user list. This targets companies tied to China's military. And fourth is the Chinese military industrial complex list. This blocks US investments in Chinese defense or surveillance firms. But here's the thing. Enforcing all of this, it's like trying to police New Delhi, Bangalore or Mumbai with just 10 police walas. That's how many export control officers the US has globally, with just 3 in China. These folks had to review 4,000 license applications worth $880 billion in just 5 years. So how do they make it work? The most American way possible. They let businesses rat each other out. That's how Seagate got caught shipping hard drives to Huawei, landing a $300 million fine. And companies like Nvidia, they're walking a tightrope, creating special, less powerful chips for China just to stay in the game while keeping US regulators happy. It's a delicate dance. But here's a plot twist. China is adapting. Those chip restrictions from 2022, do you remember? China figured out a way how to make advanced 7 nanometer chips using older tech. caught in the middle of all of this are American companies. Those export restrictions went from being their 20th biggest headache in China to number 3 in just 3 years. And the ripple effect, they're global. Europe and East Asia are stuck trying to balance their reliance on China's market with their need to stay in America's good books. Even Chinese banks are trading carefully, rejecting 80% of Russia's payments to avoid crossing US sanctions. And here's where it gets even more messier. What happens if China develops its own version of Swift banking system? Or if more countries start trading in yuan instead of dollars? America's financial weapons might lose their edge, like antibiotics that get overused. And let's not forget the military backdrop. China is building the world's largest navy, modernizing its nuclear arsenal and advancing AI weapons. This isn't just an economic battle, it's a race for global dominance. So, what does all of this mean for us? We are watching the first economic superpower showdown of the digital age. And like the Cold War shaped space travel and microwaves, this battle will shape tech and products for the next few decades. Now, on to the tidbits for the day. First, India has ended the duty-free import scheme for solar equipment, requiring companies to pay deferred custom duties on bonded warehouse goods. This move disrupts cash flows of solar firms and raises operational costs, challenging profitability amid fixed power tariffs. Number two, Ambuja Cements is merging Sanghi Industries and Penna Cement into its operations, boosting its position as India's second largest cement maker. The move leverages synergies and meets rising infrastructure demands, reflecting the Adani Group's growth strategy. And number three, Shriram Finance secured India's largest ever $1.27 billion ECB deal, reducing reliance on domestic banks and funding growth in MSME lending. The move underscores global confidence in the NBFC sector and Shriram's resilience amid regulatory tightening. And that's it for the day. I'm your host, Kashish Kapoor. This was the Daily Brief, and I'll see you in the next one.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.